I've never been to a psychic, never had my palms read, but I've always thought it would be really interesting to be able to look into the future. Every year, actually twice a year, I believe, we have the privilege of trying to take our best guess at looking into a crystal ball and deciding what the future might hold. Today's episode, what that outlook is going to be. I'm Valerie Escobar, certified financial planner and advisor with Mariner Wealth Advisors. I am joined today by Jeff Krumpelman, chief investment strategist and head of equities. Jeff, thanks so much for joining us.
Thanks for having me, Valerie.
Absolutely. So, Jeff, I am really glad to know that you have this crystal ball that you look into. How often does that come up that you're really expected to be able to tell us what the future is going to hold in the world of equities?
Well, I think you said twice a year is, when we do this. And really, it's the January crystal ball where we come out with our outlook for the calendar year. And then we simply, as we go through the year in Midyear, we kind of say it's like going into halftime. What do we think? How do we play the first half? Were there a lot of surprises? Are there adjustments that we need to make to our thinking? And how do we expect, the third and fourth quarter to go? And so it's only twice a year. I think the other thing that, you talk about, a lot of folks really think this is prophecy or something. And, we work very hard not to paint ourselves in a corner. And what we do when we lay out the future, it's all probability based and it's based on the data. We have a base case. We have this is how we expect the game plan to go. And it assumes these different factors, that the economy grows so fast, that interest rates hover at these levels, that these wall of worry items hit and they're resolved in some fashion. And if all that comes to place, and we think the odds are that will, then this will be the end result. However, if this should happen, maybe it's better than we thought. Okay, that's fun. It's going to be higher. If, on the other hand, these other risk factors become more prevalent, more troublesome, then this would be the downside that we see out there. And we put probabilities of those different scenarios. So it's not like, we think it's going to be 4,500 for the S&P 500 come heck or high water. And,
right.
We just think that. It's really based on facts and data, just like when the Fed makes decisions. They are data dependent and they look at the incoming data and then they'll make their decision what they should do as the months progress. We do the same thing.
Yeah. And, while we're talking about the Fed, they have a big job that they want to help, do their part to stabilize the economy. And so tell us what data are they seeing that, or maybe I'll ask that question differently. What do we expect out of the Fed coming up for the rest of this year?
Yeah, well, it's interesting, and you can't divorce what the Fed does from personalities and agendas that you have, right? And so a lot of folks will say to me, and they were very, we've been one of the rare voices on Wall Street or, in this business that have held a positive view for this year. And one of the reasons that people have been so skeptical is that they thought that the Fed was conducting what they called unprecedented policy of hiking rates. Well, we viewed it differently. What was unprecedented was what had come before. We were at 0% interest rates. That's absurd. And that was instituted at an emergency time in 2007, 2008. And, it's continued. And it has caused stocks to go through a 15-year bull market because there was no alternative. Well, that's not normal. What's normal is where we are right now. And that's all the Fed has done. It's returned us to normal. So, while you're in that transition, we recognize that probably stocks are going to be volatile. And they may anticipate in advance, like they did last year, as the Fed started to shift and transition to normal, They might anticipate recession and bad times. And that's what we had in 2022. We had a 25% pullback in anticipation of recession in 23 that hasn't happened.
Right.
And I think that what will happen is that the market is getting comfortable with the fact that this is just normal. Now, they might overshoot a little bit. And this is where you get into personalities. You had this guy named Jerome Powell. And for the longest time, Jerome Powell, he's a guy that really cares about employment. He cares about equality in income. And that was his agenda for the longest time. Now, he pivoted it a couple of times under Trump. He started to normalize, and Donald Trump, when president, said, "Hey, dude, you're doing this too quickly. You need to cut rates because I've got this trade war going on, and that's going to slow the economy, and you're going to kill us and put us into a recession. Don't do it." And you know what? He liked his job, so Jerome said, "Ooh, I better pivot," and he did.
Yeah.
Now that we came through this inflationary environment that was a surprise coming out of pandemics, supply chain issues, a labor market that was extremely tight that led to this more sticky inflation than anticipated. Jerome Powell also has an ego, and he doesn't want to be perceived as Arthur Burns, who was the Fed chair back in the 1970s when we had oil embargoes and prime rate went to 20%, and we had Fed funds rate of north of 15%. He doesn't want to be perceived as, a horrible Fed chair that allowed that to happen. Hyperinflation. So he became uber vigilant. But ultimately, what he truly is a full employment, equal income kind of Fed chair. And, I think we're in the 8th or 9th inning. And he's talked hawkish because he doesn't want to be Arthur Burns, a la 1970. But I think that as inflation has calmed, as it should, given what they've done and given the recovery in supply chain, we're normalizing on inflation. So you know what? If he errs towards the side of conservatism and they hike again in July, which they very well could, odds are 75% that they do that, we're still just at 5.5% Fed funds rate. While we have just the data that came out today, consumer confidence shot up far higher than expected, and new home starts are far exceeding where they are. And we're close. We're virtually at full employment. So I don't think what they've done has derailed a recovery, both in earnings in 2024, nor has it decimated sentiment on the part of investors. And therefore, even if they would just, what did they call it? It was a pause or a skip. And there's this debate, is it a skip or a pause? I don't care. Either one of them. I think the market's headed higher because inflation is coming in.
Yeah. Yeah. And so it's almost sounds like you're saying it's like this medicine that we've just not wanted to take, right? We've been so used to things being really easy and not paying any interest on our mortgages and everything else. And the Fed saying, you know what, we need that tool in case we do get tough times and we need to cut rates.
I think
and so
yeah.
Yeah. And, I guess that's the next piece of my question too is, where are we in the cycle? Usually we think about that chart that's kind of like it goes up and goes down and we get bulls and we get bears. I think with recession, or I'm sorry, with the inflation that we kind of got the sentiment, oh my goodness, the whole world's going to crumble. We're definitely going into a long-term bear. Or at least that was a big sentiment that I was hearing. What is your thought on that? Where do you think we are in that cycle?
Well, first of all, I think that, folks, when you're investing in the market, you need to take a deep breath. And one of the beautiful things about investing in the United States, sometimes we fail to appreciate how lucky we are.
Right.
Earnings are positive and the economy expands 80% of the time. We are in recession only 13% of the time. The market goes up 80% of the time. So this is one of the rare industries where it does not pay to be a pessimist.
Mm.
You're not going to be right half the time or a flip of the coin if you're negative. So the data better be negative for you to be negative. And there are times to be negative and defensive and cautious. But when the data is neutral and people are saying it's horrible, that's not a time to be negative. That's a time to hold your ground. And that's been, our message. And so where we see ourselves in the cycle, whenever, you've got an economic cycle and you've got, the market, and the market actually moves in advance of the economy and in that cycle. But let's just talk about the market for a minute that incorporates economic analysis. We look at fundamentals, we look at valuation levels, and we look at technical price trends. And when we look at fundamentals, we're looking at the economy and earnings and rates. And the economy is actually in a slow growth, kind of soft landing mode. There's nothing that says we are in a recession. Despite the traditional, indicators of recession, an inverted yield curve, which everyone cites. People also cite the fact that manufacturing activity has gone into, decline mode. Manufacturing has, and that's a typical negative. The residential housing market has been soft, and they throw those kinds of things out. For every bear argument like that, I can say, well, yeah, but we're at 3.7% unemployment. We've got wage growth when prices are decelerating. So that means after inflation income is rising, we're all-time lows in terms of debt service stress. Great balance sheets on the part of consumers. And oh, by the way, while residential housing is in slow down, you have multifamily and non-res that's at all-time highs. And you have a capital spending boom going on because of all these bills that have been passed as we re-onshore. So when I look at all that stuff, it's mixed. And I really see kind of a rolling recession in the economy, not a typical boom bust. You may have pockets of weakness, but you've got pockets of uber strength. So you mix that in a big soup bowl, and it's neutral to positive. Mm-hmm. And then you look at valuation levels, and everybody will say, oh my gosh, we're at 18 times. That's expensive. Well, we're at 30 times in 8 stocks. The mega 8 stocks are trading at over 30 times. 492 stocks in the S&P 500 are trading at 15 times or below. So that's neutral to attractive. It's below average over the last 10 years. So I don't think you can make valuation a bear case, which they want to. Mm-hmm. And when you look at earnings, that's the other thing the bears want to talk about. The average decline in earnings in a true recession, bear market, a hard landing recession like 07, 08, is somewhere a decline in earnings of 17 to 30%. Earnings should be up about 3% this year. Worst case, they're flat. Next year, they should be up 10%. They're holding in. Profit margins are beginning to improve as inflation falls, wage increases fall, productivity troughs and begins to increase, and revenues have held up. So it's really hard for me to go to that uber skeptical. And then people will point to the technicals and the price trends. The other bear argument is, well, gee, Jeff, it's the only reason the market's up is because 8 stocks are advancing. That was over advertised. That was not true. There were a number of industry groups, and we have internal strategies that we manage. Our most flexible and aggressive strategy was neutral to under-owning those mega 8. And the reason we did that was because we owned some of these growth stocks that were declared to be dead, that were, things like CrowdStrike and Palo Alto and Synopsys and Bookings and Decker Shoes, all kinds of beautiful growth stocks that were extremely cheap. And so the market was broader than folks advertised then, but over the last month, it's really broadened. The industrials are participating, and that's a good sign. It's not just a few stocks that are going up. We need to see more of that. It's not perfect. It's not beautiful. It's not 90% of stocks above their 200-day moving average, which you see in a typical bull run, but it's 60%. It ain't 30. So that gives us comfort and conviction that we're on a good path, a less worse path. That's all you need for the market to advance, less worse.
Yeah. And it's making it hard to be a pessimist, to look at it and be sad, which is awesome. I love not being sad. And I mean, in the end, there is so many options, right? And so, yes, maybe there's a little bit of bad, but when are you ever going to get everything completely golden? And so it sounds like there's lots of opportunity, lots of good reasons to be optimistic and to hold your course. Is that what I'm hearing?
Hold your course. And the reason people ask me a lot, I think it seems like, and I love this quote. There's a book called Factfulness. And the gentleman who wrote it, I think it's Rosling. He's a medical doctor and a PhD both, and he does all kinds of great research on just the world order and facts about the world, poverty rates, education, where we stand on education of young women throughout the world, health, climate, all that stuff. And his whole point is that we're living in the 1960s. We think the statistics are worsening, and actually they're getting less worse. We just don't realize it because of the negative media press that we get. Mm-hmm. And he says, you know what? I'm a possibilist. I'm not, people accuse me of being an optimist. I'm not an optimist. An optimist means you're naive and you're biased and you're always positive. Possibilist says I'm open to the facts and the fact that it could be good or bad, but it looks like we're on our course of possibly, really improving. And, the reason that I'm not an optimist and just uber positive right now is because we're neutral in those things that I just mentioned. And there are issues out there. And so at that point in time, you don't want to be buy on the dips. Oh, let's go, baby. We're off to the races. But you also want to be a realist or a possibilist and say, things are not getting worse. They're getting less worse. So hold your ground. Wait until everyone else is, in our camp, in our view, because of some of these concerns that are truly look like they're resolved, like inflation, like, okay, it's clear the Fed's it's gonna pause. Really, it's just not our prophecy. And then you're going to enjoy the ride, and you can let your allocation ride. Right now, be neutral. So if you're a 60% long-term equity investor, that's where your allocation should be. Be there. 3 years ago, prior to 22, we're saying let it ride. If it's drifting up to 70%, let it go. Mm. Right now, we're saying nope. Be respectful of risk, but boy, don't run for the hills. So yes,
just stay disciplined. Awesome. Thank you, Jeff, so much for joining us today. For all of you listeners out there, be sure to like and subscribe wherever you are tuning in. And also be sure to join us on our webinar, the Midyear Review and Crystal Ball Outlook. Thanks again.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.